At 1:47 p.m. on March 9, 2023, Roku's finance chief opened his laptop and typed 11 words that would trigger the second-largest bank collapse in American history. The fluorescent lights hummed overhead in Silicon Valley Bank's Menlo Park headquarters as employees stared at screens showing withdrawal requests flooding in faster than human hands could process. Each ping of a mobile notification meant another million gone. Venture capitalists who had built fortunes on patient capital were now racing to pull deposits before lunch ended. The bank that had funded half of America's startups for 4 decades was about to learn what panic looked like when it moved at the speed of a retweet. By market close, $42 billion would vanish from Silicon Valley Bank's balance sheet, and regulators would discover that social media had rewritten the rules of financial contagion forever. Greg Becker had run Silicon Valley Bank for 12 years without a single quarterly loss. He understood the venture capital world like few bankers could, knew that startup money moved in waves, not steady streams. But on March 8, 2023, Becker faced a problem that his experience couldn't solve. Interest rates had climbed faster than anyone expected, turning the bank's government bond portfolio into a $15 billion anchor. The math was brutal and simple. SVB had borrowed short from depositors and lent long to the Treasury. When rates spiked, those bonds lost value faster than a crypto crash. Becker made the call that seemed logical at the time. Sell the bonds, take the loss, raise fresh capital. He announced a $1.8 billion hit and a plan to sell new shares. The market would understand, he thought. At Founders Fund, Peter Thiel's team was reading Becker's announcement with the focus of bomb disposal experts. The venture capital firm had built its reputation on seeing around corners, and what they saw made them reach for their phones. Thiel's partners calculated that if SVB needed capital, other depositors would figure that out too. In the old days, this realization might have led to quiet conversations over lunch, maybe some discreet withdrawals spread across weeks. Instead, at 3:30 p.m. Pacific, Founders Fund sent a note to their portfolio companies with 3 words that would echo across Silicon Valley: "Get out now." The WhatsApp messages started immediately. CEOs texted their CFOs. CFOs called their bankers. Within 2 hours, the phones at SVB branches were ringing hot with withdrawal requests. David Sachs had weathered financial storms before. The PayPal co-founder turned venture capitalist understood that in moments of uncertainty, the first mover wins. By 5 p.m. on March 8th, Sachs was already drafting the tweet that would make Founders Fund's private warning public. "Silicon Valley Bank is in crisis," he typed. "If you have deposits there, you should withdraw them ASAP." He hit send at 7:43 p.m., and the notification ping started within seconds. Retweets multiplied like a chain reaction. By midnight, Sachs had done what would have taken whisper campaigns weeks to accomplish in previous decades. He had turned a bank's balance sheet problem into a public relations crisis that reached every startup founder on the West Coast. The early movers were already safe. Everyone else was about to pay the price. What Sachs and Thiel didn't calculate was the feedback loop they had created. Every tweet, every shared article, every Slack message warning about SVB's troubles convinced more depositors to withdraw money. And every withdrawal made the bank's situation worse, validating the warnings that caused more withdrawals. Sarah Fryer, former CFO of Square and a veteran of the 2008 financial crisis, watched the cascade unfold from her home in Palo Alto. She had seen bank runs before, but never at this speed. It used to take days or weeks for panic to spread, she would later tell regulators. Now it happens in hours. The cost of instant communication wasn't just speed. It was the loss of the cooling-off period that had historically given banks time to stabilize. In the smartphone age, panic and liquidity moved at the same pace. By Thursday morning, March 9th, Greg Becker faced a decision that would determine whether SVB survived or became a case study. The bank had lost $24 billion in deposits overnight, but Becker still believed he could manage the crisis with clear communication. At 10:30 a.m., he convened an all-hands video call with employees. The fluorescent lights buzzed overhead as staff gathered around conference room screens. Becker's message was measured and confident. The bank was fundamentally sound. The bond loss was a one-time event. Fresh capital was on the way. But his audience wasn't just SVB employees. Screenshots of internal communications were already circulating on Twitter. The private reassurance became public contradiction. When leaders say, "Don't panic during a panic," the message often amplifies the very fear it's meant to calm. The Federal Deposit Insurance Corporation insures bank accounts up to $250,000. It's the bedrock promise that has prevented major bank runs since the 1930s. But Silicon Valley Bank had a problem that FDIC insurance couldn't fix. 94% of its deposits exceeded the insurance limit. Venture-funded startups often kept millions in checking accounts to fund rapid growth. Roku alone had $487 million at SVB. When panic hit, these large depositors had the most to lose and the least protection. The FDIC safety net that had worked for neighborhood banks was full of holes when it came to Silicon Valley's cash management. Insurance wasn't insurance when your balance had 7 zeros. The uninsured depositors rushed for the exits first, and their exits were big enough to matter. At 1:47 p.m. on March 9th, Dan Rayburn sent the tweet that sealed SVB's fate. Roku's chief financial officer announced that the streaming company was withdrawing all deposits from Silicon Valley Bank as a precaution. Rayburn's 11 words, "We have withdrawn all deposits from Silicon Valley Bank," hit social media like a starter's pistol. If Roku was pulling out, every other startup should too. The bank's stock price fell 60% in after-hours trading. By 2:30 p.m., SVB's withdrawal requests exceeded the bank's cash reserves. Greg Becker called the Federal Reserve, then the FDIC, then the California Department of Financial Protection. The message was the same everywhere. 24 hours ago, we had a capital problem. Now we have a liquidity crisis that no amount of fresh investment can solve. While Silicon Valley Bank dominated headlines, a quieter signal was flashing red in markets that most people never watch. The TED spread, the gap between 3-month Treasury bills and 3-month interbank loans, spiked to levels not seen since 2020. Credit default swaps on regional banks doubled overnight. But these warnings lived in trading floors and regulatory offices, not on Twitter feeds or Slack channels. The crash signal that reached ordinary people was simpler and more devastating. At 3:15 p.m. Pacific, California banking regulators shut down Silicon Valley Bank and handed control to the FDIC. The bank that had opened that morning worth $15 billion was now worth whatever federal regulators could recover from a fire sale. Jennifer Wong had co-founded a food delivery startup that served Asian restaurants across 6 cities. Her company kept $2.3 million at Silicon Valley Bank, money that was supposed to fund payroll for 87 employees through the summer. When SVB collapsed, Wong faced a choice that thousands of entrepreneurs confronted that weekend: pay rent or pay workers. The rent could wait. The workers could not. Wong borrowed against her house. Her co-founder liquidated his retirement account, and together they covered 2 weeks of payroll while waiting to learn if their startup's bank account still existed. The federal safety net had protected Wong from losing her personal savings, but it offered no protection for the working capital that kept her business alive. Treasury Secretary Janet Yellen spent the weekend of March 11th in meetings that would determine whether Silicon Valley Bank's collapse stayed contained or spread across the financial system. The Federal Reserve had tools to lend money to banks, but SVB was already closed. The FDIC had authority to protect insured deposits, but most of SVB's money wasn't insured. Yellen faced the same dilemma that had haunted policymakers since 2008. Let the market punish bad decisions and risk contagion, or step in and risk moral hazard. She chose containment. On Sunday night, Yellen announced that all SVB depositors, even those with millions in uninsured accounts, would be made whole. The taxpayers wouldn't pay directly, she explained. Instead, healthy banks would contribute to a fund that covered the losses. It was a bailout without calling it a bailout. Maria Gonzalez managed the pension fund for a school district in Central California. Her fund had no deposits at Silicon Valley Bank, no investments in tech startups, no connection to venture capital. But on Monday morning, March 13th, Gonzalez watched the pension fund's stock portfolio lose 8% of its value in the first hour of trading. Regional banks were selling off across the board. Investors who had never heard of Silicon Valley Bank were pulling money from any institution that looked remotely similar. The contagion had escaped tech and found its way into the retirement savings of teachers, janitors, and cafeteria workers who lived 200 miles from Palo Alto. Financial panic, Gonzalez learned, doesn't respect geography or industry boundaries when it travels at the speed of social media. When the FDIC published Silicon Valley Bank's final balance sheet, the numbers told a story that the headlines had missed. SVB hadn't failed because of risky loans or fraudulent accounting. The bank had failed because it had grown too fast for its own risk management. Deposits had tripled in 3 years from $60 billion to $180 billion. The bank had invested that flood of cash in government bonds, the safest possible choice. But safety and stability aren't the same thing when interest rates move faster than your balance sheet can adjust. SVB's mistake wasn't moral, it was mathematical. They had bet that rates would stay low and lost when the Federal Reserve changed course. In the new economy of instant communication, even safe bets could become fatal when they went wrong in public. The printer heat rose from machines running overtime at Signature Bank in New York as lawyers worked through the night to prepare documents that might keep their institution alive. Signature had no direct connection to Silicon Valley Bank, but both banks served industries that moved money quickly and talked frequently online. Cryptocurrency companies had flocked to Signature the same way tech startups had flocked to SVB. When depositors saw the pattern, they drew the obvious conclusion. By Tuesday morning, Signature faced the same spiral: worried depositors, urgent withdrawals, frozen stock price, regulatory intervention. The second-order costs of SVB's collapse weren't limited to copycats. Credit markets tightened as investors repriced the risk of regional banks. Small businesses found loans harder to get. The price of avoiding another bank run was making credit more expensive for everyone. Federal Reserve Vice Chair Michael Barr arrived in Silicon Valley on March 15th to begin the investigation that should have happened 6 months earlier. Barr's team spent 3 days interviewing SVB executives, reviewing risk management protocols, and mapping the social media cascade that had turned a capital shortfall into a liquidity crisis. What they found was a regulatory blind spot that had been hiding in plain sight. Bank supervisors had tools to measure credit risk, interest rate risk, and operational risk. But they had no framework for measuring viral risk, the speed at which bad news could spread through connected networks of depositors. The regulations that had worked when information moved slowly had become inadequate when information moved at smartphone speed. Barr's recommendations would take months to implement, but the next crisis would arrive at Twitter speed. By the end of March, Silicon Valley Bank's collapse felt like old news. The FDIC had sold the bank's assets to First Citizens Bank, most depositors had recovered their money, and stock markets had moved on to other concerns. But the calm felt wrong to people who understood the deeper currents. Chris Whalen, a banking analyst who had predicted the 2008 crisis, spent his days fielding calls from regional bank executives who were quietly shoring up their defenses. They were stress testing their deposit concentrations, diversifying their funding sources, and most importantly, monitoring social media for any mentions of their institutions. The brief calm wasn't resolution. It was preparation. Everyone knew the next bank run would start with a tweet, and no one knew when that tweet would come. The fluorescent lights that had hummed over Silicon Valley Bank's final hours now illuminate a different kind of office space. In Washington, D.C., banking regulators work late into evenings, building new systems to track social media sentiment and monitor deposit concentration in real time. They call it social listening for systemic risk, but the name doesn't capture what they're really doing. Teaching 20th century banking supervision to survive in a 21st century world where panic travels faster than policy. The changes go deeper than new monitoring tools. Regional banks now stress test their deposits against viral scenarios, modeling what happens when their largest customers tweet about leaving. Venture capital firms have quietly built internal protocols for how they communicate concerns about portfolio companies' banking relationships. Even the Federal Reserve has hired social media analysts, people whose job is to watch for the next David Sachs tweet that could trigger billions in withdrawals. But the most important change isn't happening in regulatory offices or bank boardrooms. It's happening in the group chats and private messages where money managers decide where to park their cash. Trust, the invisible foundation of all banking, now builds and breaks at smartphone speed. The next bank run will start the same way Silicon Valley banks did, with someone typing a message they think only a few people will see, not knowing those few people will share it with everyone. The question isn't whether social media will trigger the next financial crisis. The question is whether we'll build the tools to contain it before the fluorescent lights start humming over another empty conference room and another set of regulators arrives too late to stop the cascade. If this story made you think twice about where you keep your money or how fast trust can vanish in the digital age, hit subscribe. Because the next bank run is already brewing somewhere in Silicon Valley. And when it starts, you'll want to know the warning signs before they trend on Twitter.